Yes Bank shareholders had to bear the brunt of the corporate governance lapses by the founder promoter and the new management's inability to bring in the requisite capital to clean up the books. Let's do a three-point analysis to really understand and find out what's the way forward for the bank. 1. What does SBI bring to the table? Well, a new board at Yes Bank will be constituted consisting of the CEO and also the MD. Also, non-executive chairman and non-executive directors will be chosen. SBI shall appoint the nominee directors as well on the board of the reconstructed bank, and RBI as well can appoint additional directors onto the board as well. Now, all employees of the reconstructed bank shall continue in service with the same remuneration at least for 1 year. Now, board, however, will have the freedom to discontinue services of any key managerial personnel. Before the reconstruction of the bank or the plan takes effect, Yes Bank had 255 crore shares with a face value of 2 rupees, amounting to an equity of 510 crore rupees, and shareholders' funds amounted to over 27,000 crores in September 2019. Now, for a 49% stake, SBI will subscribe to 245 crores of new shares at a price of 10 rupees, which is a premium of 8 rupees, thereby putting investment of close to 2,500 crores as initial commitment. In addition, Yes Bank's 81 bonds of 8,600 crores will be written down, paving the way for a similar quantum of write-off on the asset side as well. Now, at this stage, the identified toxic assets are about 31,000 crores, similar to the sub-investment grade book of Yes Bank of 31,400 crores at the end of September 2019. Now, SBI is infusing capital at 0.2 times Yes Bank's last reported book value. 2. How will the much-awaited cleanup take place? Well, the quantum of assets that will have to be written off is not known currently, but it is not unrealistic to really assume that it could be in excess of the declared sub-investment grade book. Now, with 81 bonds write-downs taking care of only about 8,600 crores, the massive write-off that is warranted will be contingent on the availability of new capital. Now, the reconstruction proposal creates a window for the same with the expanded equity of the reconstructed entity at 2,400 crore shares or 4,800 crore equity capital. To maintain a stake of 49% in this expanded equity, SBI will have to commit capital to the tune of 11,760 crores. However, under the scheme, SBI is required to maintain a stake of not less than 26% to lend requisite confidence to new investors in the coming 3 years before the bank is fully nurtured to health. Now, a 26% stake for SBI on the expanded equity base of Yes Bank would entail an additional capital commitment beyond the initial infusion of 3790 crore rupees. Now, this would leave enough headroom to issue equity to new investors of the order of about 1520 crore shares or 63% of the expanded equity. Now, any investor coming within the moratorium period will definitely come at a valuation agreed upon with the SBI. Now, the upside to Yes Bank rests on the fact that its success in getting new investors at a premium to the valuation paid by SBI. Post SBI's entry lending credibility, if Yes Bank manages to get new investors at a decent premium, then the additional capital can progressively be used to write off the toxic assets. 3. What should investors do then? Well, the existing investors have already seen a lion's share of their wealth eroded as the stock crashed to single digits recently from the high of above 400 rupees. Now, SBI picking up a stake at 10 rupees, 0.2 times the book value, doesn't lend comfort beyond the fact that the bank survives, and also there is minimum collateral damage on the financial system per se. Now, investors would want to see if the financial results to be declared on 14th of March shed better light on the exact quantum of the toxic assets. Now, if the figure is similar to about 40,000, 45,000 crores, that the market is already factoring in largely. And if Yes Bank manages to get the requisite capital with the expanded equity, then perhaps a new journey can begin on a clean slate after several quarters of rather painful adjustments. However, the capability and the commitment of the new management, to what extent it is able to really compete with the savvy, well-capitalized private peers and is able to change the color of its loan book, more granular retail and also liabilities retail and both low-cost focused, remains to be really seen. While Yes Bank's survival has therefore been taken care of, regaining its past glory is definitely not a given right now. Now, existing investors who have had a painful journey with its shares may actually like to piggy bank on SBI's investment and hence average at the lower price levels that we are seeing right now. For new investors, the road to prosperity is not given. Only those with an appetite to stomach the risk and volatility should really consider this.